Good afternoon, everyone, and welcome to this ACBC 5121 Accounting 1 workshop. So the aim for the workshop today is we are going to focus on Learning Unit 2 and Learning Unit 3. Now, some of you might be repeat students, and this is to help just fill in the gaps that you might have had from the prior year, which resulted in you not passing this module. And for the guys that are doing this for the first time, this will help you just to get on top of the work that we have done so far, because I know it's a lot of information, it's information overload, and especially if you have not had accounting, it is a bit of a challenge. So in the session, the first part, we're going to do the basics, the key concepts that you need to know for the specific modules or learning outcomes. And then in the second part, we're going to work through a question, which was a question that they asked the students in the prior year. And I'm going to work through it with you guys and show you how to actually answer the question. What do you need to highlight when you go through the question in order to get the maximum marks in the minimum amount of time? Okay, because that's generally where a lot of students also fail, is because of the fact that they can't process the information quickly enough, or they don't know what the information means in order to answer the question. What I want you guys to do, if there's anything that I said that you don't understand or you want me to re-explain, please just type your question in the chat function or raise your hand. I will stop and then we can just continue from where I've left off. Or alternatively, if you want to make a few notes of questions, then I can always address it at the end when I open it up for questions. It's all up to you. So please don't feel like you can't ask any questions. This is to assist all of you. And yeah, to make sure that you guys are up to standard and that you know what's going on, please just ask me questions. Remember, there's nothing like a stupid question in accounting, because most of the other students generally also have a similar type of question. Okay, so the first learning unit we are going to start off with today is Learning Unit 2, which talks about our accounting equation and double entry system. This is only one learning unit, but this is the basis and the foundation of accounting. This is how we actually account for each and every transaction, and this is what we are going to build on in the other learning units. So the problem is, if you do not understand the accounting equation and double entry system, you will struggle to eventually do the journal entries and put them into your general ledger accounts, because you don't understand the basic concepts. So today we're going to go back, we're going to look at the accounting equation and double entry system, and we're going to talk about the different components that you need to be aware of. Okay, so this is the first learning unit. It is the basis of accounting. A lot of students already lose the plot in this learning unit. So if there's anything after I've discussed it that you're still unsure about, please just ask me so we can talk about it and clarify whatever you're still wondering about. Okay, so the first thing is the accounting equation is made up of three areas or categories. You've got the asset category, liabilities, and equity. Now, the main one that a lot of students know is assets equals liabilities plus owner's equity. Now, what is the difference between these three categories? Together, they show you what is the net worth of an owner within a business environment. Assets are things that we own. So you can see here, assets are what we own. It can be something that I've leased, but I've got control over it. I can determine where it's going to function, when I'm going to use it, what I'm going to manufacture with it, or if I'm going to use it in my inventory system, am I going to use it to drive my staff around, who will then generate some income for me? It all depends on how the company that owns it controls it and use it to generate future revenue. Your liabilities and equity. Liabilities is something I owe. I owe someone money for something they have given to me, whether it's an asset or whether it is an expense that they've provided or a service. Owner's equity, on the other hand, is also funding. It's money that I owe the owner back if we close the business. That is generally how we fund our business. We can fund it through either liabilities, debt, or we can fund it through owner's equity, so the shareholders put money into our business. Now, for an accounting equation to work, the left-hand side, which is your debit side, always needs to equal what is on your credit side. Now, the equation we've got here on the screen is assets equals your liabilities plus equity. Now, this is one of the main equations you will see, because this is also how we structure our financial statements. We list all the assets on one side of the financial statement or one category, and liabilities and equities is added together. In your textbook, however, we do have variations of this accounting equation, and you guys need to know what the variations look like. So we can, for example, start with owner's equity, and then you need to know owner's equity equals assets less liabilities. And I can also, instead of giving you owner's equity, I could give you the components that makes up owner's equity. And what would that be? That would be capital, less drawings, and then it would be your profit or loss for the year that you would add to it. So you can see there's quite a few different ways we can ask this, and we can test if you understand what are the basic concepts, as well as how do they fit together. With a double entry system, the one thing is what happens on the one side, so what happens on the debit side, should always have an equivalent entry on the credit side. So what that means is if I, for example, have a vehicle that is worth 10,000 Rand on the debit side, I will have an equivalent credit of 10,000 Rand. Equivalent credit of 10,000 Rand, which would either be the bank, so the money I've paid, or it would be a loan, so the money I've loaned from the bank, or alternatively it would be capital, so the capital contribution I've received. So that would mean my debit, my assets, which is 10,000 Rand, would equal either my liabilities or equity of 10,000 Rand. Now, the different components in accounting is the components that feed into our financial statements. That is, at the end of the day, what we do. We take a transaction, we record it in our journals, then we record it in our general ledger. From there, we take it to the trial balance, and then once we've populated a trial balance, we flow it into our financial statements. Now, all of these categories that makes up the accounting equation actually flows into our financial statements, because that is what we want to achieve at the end of the year. We want to create a snapshot for our owners of what is, and the other users of financial statements, what is our current net worth in this business, how are we performing, so what is our profit like, our revenue, our expenses, and then when we look at the assets and liabilities, are we liquid, are we solvent? So all of that we see in our set of financials. Now, in your textbooks on page 26 to 41, they give you the definition of each of these elements, and you need to know what they are. They have not really asked them in a test before, except for the cost of sales they've asked previously. But in order to, when you have to do the classifications, it is quite important that you know which element means what. Okay, so let's quickly talk about the different elements. So if we start with assets, assets is a present economic resource. So it's a resource that the business currently control. And it is as a result of a past event. So when we talk about a past event, something happened previously that resulted in you owning that asset. Now that past event could have been, I've purchased it, it was given to me or donated to me. That is what, as a result of a past event, means. Now, that economic resource, that asset that we control, has the potential to produce economic benefits. Now, when we talk about economic benefits, we are talking about revenue that it will generate for our business. Okay. Or alternatively, it could also be a reduction in expenses. So if we, for example, implement machinery that makes our production process more efficient, it will reduce the cost, which will then, in the long run, increase our profits. Okay, that is what an asset is. The next thing is liabilities. Now, liabilities are also debt. It's money that I owe to someone. It is a present obligation of their business to transfer their economic resources. Now, economic resources is money that the business have. You have to transfer it to another party to pay for that debt. Now, that economic resources would generally come from the revenue that you've generated. That money that you receive, you will use to pay someone else. And that was also as a result of a past event. So I borrowed money or I purchased something on credit. That is what the past event is. Okay. And assets can also be converted into cash in the future or used to produce economic benefit. So we acquired something with the use of that liability in order to produce economic benefit. So the liability is how we funded the asset. Okay, so that's what that means. Owner's equity is the difference between your assets and your liabilities, which shows us our net worth of the owner in your business. Okay, now what is very important specifically for equity is we can, and we call this the business entity rule, is we are only allowed to record the owner's wealth within the business. So his personal wealth outside of the business will not be accounted for in our business financial statements. Okay, so that is very important to remember, that for the business entity rule, we are only allowed to record the business equity, so the business net worth in the business, whereas the owner's net worth, his personal net worth, is accounted for separately. Okay, then revenue could also be income, is a different terminology for it. Okay, so income is an increase in your assets or it is a decrease in your liabilities that results in an increase in your owner's equity. Whereas an expense is exactly the opposite. An expense is a decrease in your assets, but an increase in your liabilities, which results in a decrease in equity. So those are the definitions of the main categories. Now, cost of sales generally falls under your expenses, but cost of sales is an expense that specifically relates to your trading inventory that you've previously purchased and now you've sold it. That is what cost of sales refers to. And then if I take the revenue, I deduct the expenses, I get the profit. And the profit component flows into our owner's equity at the end of the year to update the balance of what the net worth would be after we've closed off our books for the year. The general ledger system is the next thing that you guys need to understand. Now, you will see I've given you T accounts for each and every type of category. Now, in class, I've explained debt click. It says on the debit side, we increase expenses, assets, and drawings. On the credit side, liabilities, income, and capital will be increased. So how this works is the increase here is the green arrow and the decrease is the red arrow. At the bottom, it also tells you whether it's debited and credited and whether it would be a positive or negative effect. Now, this diagram is very useful when you study for your accounting equations as well as your general ledgers. Okay, so let's quickly have a look at this. So In our example, we said we purchased a vehicle. Now, if we get a vehicle, our assets increase. So we are going to debit vehicle with 10,000, so it's going to increase by 10,000. We said we actually bought it on credit, so that means we have a liability. So on the credit side, our liability or loan, however we financed it, would increase, and that means there's a positive 10,000 on the credit side. Now, how do I know it balances? We've accounted for the double entry system. The debit side equals the credit side. Both of them have a positive 10,000 Rand. Okay, now what is very important to remember is we choose one debit and one credit. So you have to have at least one debit, one credit. When we get to your VAT component, then you might have two debits and one credit, or one debit and two credits. But the basis of that equation, whatever is on the debit side, the total will always agree what is the total on the credit side. Okay, that is how you know that you have balanced an account. So each and every transaction, you do them separately to make sure that you do the double entry system. Otherwise, you will miss something, and then at the end of the day, it won't balance. And then once we've got one debit entry, one credit entry, our system will balance, and that means we have actually applied the double entry system correctly. Okay, before I move on, are you guys okay with date click and how you know what increases, what decreases? Okay, great. So just another name for general ledger, just for interest sake, is a T account. Now, how do I know it's a T account? Is because if you look at this general ledger account, it looks like a T form. So that is in practice, if you hear of the terminology a T account, this is what we refer to as the general ledger account, where we record a transaction. Now, each transaction will have their own general ledger account, and the account name would be at the top where the expense, asset, drawings, liabilities, income, capital is currently shown, would be the account name that we have included in our accounting system. So that would be, for example, vehicles, bank, it would be a loan, it would be capital, it would be revenue. So those are your general ledger accounts. The next concept that a lot of students struggle with is the markup percentages. Now, there are two methods in which you can calculate your markups. The one is on cost, the other one is on selling price, or the gross margin percentage. Now, why this is important? When we look at our inventory systems, you will require these markup percentages in order to calculate the cost. In the question, we will provide you with the selling price, but we will require you to work out what is the cost that needs to be removed when we dispose of the inventory. Now let's look at the first method. Now, how do I know what is the markup percentage? Okay, so the markup percentage, we use the markup percentage over the profit percentage, but on cost. Okay, so that means the markup is our profit percentage. The profit percentage on cost is, if our profit is over cost, cost will always represent 100%. Okay, so this means the percentage that we are going to work out for our selling price is going to be the cost plus the profit. So this means cost is 100%, our profit percentage is then added onto it, and then our selling price would be the 100% for the cost price plus the profit percentage to get the sales percentage. And then if you've got a Rand value and you want to work out what is the profit or what is the cost, but in rand value, you take these percentages, you multiply it with what you want. Okay, so am I trying to calculate the cost? Am I calculating the profit, or I'm trying to calculate the selling price? Over what do I have? So the value that they've given you, the rand value, which one of these three does it represent? And that would be at the bottom. So the calculation is you take the value they've given to you, you multiply it with the percentage that you want, and you divide it with the percentage that you currently have. And this is how you work out the markup percentage if it's a cost price. If it is the gross margin, so that's the other method, your profit percentage is on your selling price. Okay, so markup goes with cost, gross margin goes with selling price. Okay, so what does that mean? Our selling price, our cost would be the 100% because the selling price is going to be the 100. Our profit percentage would be given to us. So our cost percentage would be the 100 less what the profit is to work out what is the cost price percentage. And then the way to do the calculation is exactly the same as your markup percentage, but your percentages would just look slightly different. Okay. And this is how you do the markup percentages. Now, what happens if they give you, for example, this scenario, but they want you to work out the gross margin? So now they tell you, okay, our cost price is 100, our profit is 25, and our sales price is 125. Okay, but now I have to go work out the equivalent gross margin. My profit would be, I would want to know what is the profit, but I wouldn't know what the profit is. So I would have to take the cost over the selling price in order to get to that markup percentage. But I'll show you a little later how we work it out. But this is the theory behind it. Then the last thing in Learning Unit 2, this is where we start to talk about the different inventory systems. There are two inventory systems. You need to know the difference between the two. In your textbooks, they have a very good example to show you the transactions and how they differ between the two systems. Make sure that you understand this. Okay, but let's start with the main and the main difference. On the periodic inventory system, when we acquire inventory or when we purchase it, we take it to the expense account, the purchases account, straight from the beginning. Whereas under the perpetual inventory system, we take the inventory we've acquired and we take it to the asset account. And then only when we sell it under the perpetual inventory system do we take it from the asset, the inventory account, to the cost of sales, our expense account. Okay. So let's quickly look at what is the main differences. So routine purchases, for periodic, we debit the purchase account and any other expense accounts. Whereas under the perpetual, we debit the inventory account, all the cost that is necessary to get that asset to its condition and location for our business to be able to sell it. Okay, under the periodic one, if we sell the inventory, we do not make a specific entry for the sale because the inventory was already recorded as an expense previously. Whereas for your perpetual one, we would debit the cost of sales, which is our expense account, and we would credit the inventory. So this is where we're moving it from our inventory account straight into our expense account. And then at year end, so this is after the 12 months have finished, for the periodic system, because we took it to purchases, we don't know what our cost of sales for the year is. We do a physical inventory count to see how much stock do we still have on hand, and then we work out the cost of sales at the end of the year. Now, periodic inventory system will also be covered in Learning Unit 6. Make sure that you know how to calculate the cost of sales for your inventory using the periodic inventory system because I do love to ask this. Under the perpetual inventory system, because we're taking it to cost of sales when we sell it, we do not have to do anything here because we already also know what is the inventory on hand at that specific date and point in time. Okay, so that is the two main differences on your inventory systems. Okay, before we start with that, do you guys have any questions on accounting equation, markup percentages, or on inventory? If you've got a question, please just type it in the chat function, or alternatively, you can just pick up the mic and you can ask me your question. Yes, we are going to do an example in the next session. So for this session, we're just doing the theory first, and then we'll do the example in the next one where we work through two questions that focus on the accounting equation as well as the VAT and market percentages. Okay, any other questions before we move on? Okay, so let's talk about VAT. VAT is the next topic where students really struggle. VAT is an indirect tax that we pay in South Africa. And just like accounting, a lot of students struggle with tax. Okay, because both of them are numeracy modules, and students that study law tend to have a bit of a struggle when it comes to the numeracy and more practical modules. Now, the problem with this module is if you do not understand this, when you get to Learning Unit 4, Learning Unit 5, Learning Unit 6, and 7, you will struggle because all those journal entries that you have to do, that is an integral part of those learning units. And what it means is that you need to understand the basics in order for you to be able to apply it correctly to your journals. Okay, so let's have a look. I've put a little cash slip on the screen just to show you as well that we get different types of VAT categories. Now, the 4 categories that you need to be aware of. The first one is our standard rated one. So that is your everyday products that you buy at a store. So for example, your standard rated ones would be your milk tart, your apple crumble, yeah, your marshmallows would have been a standard rated supply. Okay, your zero rated supply is more your basic food stuff. There are certain items on that list which government does not add any VAT on, or they add VAT at a 0%, which is a R0 VAT. Now on your payslip here, you can see the sunflower oil, the brown bread seed, and the brown bread loaf got little stars next to it. Here at the bottom, you can see it's 0 rated VAT. So you did not actually pay any VAT on those items. Your non-allowable items. Those are specific items that a business acquire where you are not allowed to claim input VAT. Okay, examples of that is an entertainment expense, passenger vehicles, or your club's fees or subscriptions. In a question, when you see those items, you should not add or should not take out any VAT when that item was purchased. The full VAT amount will be incorporated in the amount, so the full amount will go to the other general ledger account. Exempt supplies, on the other hand, is something that does not have any VAT on it. Okay, for example, would be your interest that you received or you paid, life assurance, it would be rental accommodation for your private residence. If it is for holiday accommodation, it would fall under your standard rated. Okay, so let's look at a few things regarding these. So it's very important that you know the difference between these four categories, because in your accounting equation, as well as your journals, if you do not know the different categories, you will get the other amounts incorrect and you would lose those marks. Okay, now your standard rated items you can claim back from VAT as 15% was charged on it, whereas zero rated, exempt supplies, and non-allowable, you will not be able to claim any VAT on it because no VAT was actually calculated on zero rated and exempt, and for your non-allowable, it is a zero based on that. Now, how it works is if I make income, I automatically, and I'm registered for VAT, I have to put 15% on those items that I sell, and I have to pay that 15% over to SARS. But then what SARS says is because of the fact that I'm creating taxable supplies, whatever I acquire in order to make those taxable supplies, I will also be able to claim the input VAT on it. Okay, so let's look at a few examples for your VAT supplies. So your standard rated ones, whatever does not fall in your zero rated, exempt, or non-allowable items will all be standard rated. Okay, so let's quickly look at a few examples for your zero rated supplies. Zero rated is, for example, your petrol, your diesel, your illuminating paraffin, certain basic food stuff, for example, brown bread, white bread flour, it would be sardines, would be included there, fresh fruit and veg. And then there's more examples. So your sale of a going concern, that means you're selling a business that will continue within the next 12 months. Okay, if we look at exempt supplies, we have life assurance, we've got interest received or interest paid, renting of private accommodation, and any travel by bus, taxi, or train, or even boat would be included in there. Note, however, that travel by airplane or in the air is not included in your exempt supplies, and that would form part of your standard rated supply, as well as their petrol would also be standard rated supplies. And then our non-allowable items, those are the items where no input VAT may be claimed, is your entertainment expenses, and that includes any expenses that you incur for your staff, is also seen as entertainment. Any passenger vehicles, now those are vehicles that seat 2 to 20 people, will be seen as a passenger vehicle. In your question, we will specify if it is not a passenger vehicle. So it would be, for example, a delivery vehicle, or we will tell you it does not meet the definition of a motor vehicle in terms of the VAT Act. And then club fee and subscription fees is for the more personal nature or private nature, like your golf club fees, tennis club fees. If it is a professional subscription, for example, a doctor that needs to be registered with the medical board, or a lawyer with the law society, or an accountant with the accounting board, those subscriptions will be standard rated and not be non-allowable in terms of this definition. Okay, now how do we practically work this out? What is very important to note is that we get a VAT inclusive amount, a VAT percentage, and a VAT exclusive amount. Now, VAT inclusive amount is your VAT exclusive amount plus the 15% VAT gives you the VAT inclusive amount. Okay, so that is why this is 115%. VAT is 15%, and then VAT exclusive is 100%. Okay, Now remember, generally the figures they give to you in a test, if they specifically tell you it's VAT inclusive, VAT has already been included in that amount. So what we would generally want to work out is the VAT exclusive amount or the VAT amount. If they give you a VAT exclusive amount, then you're sitting with 100%, but you still have to add the VAT on to get to the sales amount or your debtors amount or your creditors amount. Okay, so the first thing with these types of questions is you need to determine, am I sitting here as VAT exclusive or am I sitting here as VAT inclusive? If you do not know the difference, this is where a lot of students lose the marks because of the fact that they are using the incorrect percentage. Remember, money that is paid, received, debtors, creditors will always be booked as VAT inclusive because that is the money we receive. We're receiving the amount for our sales plus the VAT that we've added on top of it. So we receive that money and then we only pay over the VAT component. And then VAT goes to VAT import or output, and the rest gets booked to what was actually sold or bought, which is either your sales, stationery, telephone, whatever the accounting name is. Okay, so let's quickly talk about if they ask you something like what is VAT payable, VAT refundable. It is output VAT less your input VAT. Now, your output VAT is the VAT that you raise on the goods that you have sold that you will pay over to SARS. Whereas input VAT is the VAT that I can claim from the goods that I have purchased from a supplier. Now, the net VAT payable or refundable will be dependent on whether the output VAT is bigger than the input VAT or not. If output VAT is bigger than input VAT, you will have a VAT payable. If the output VAT is smaller than the input VAT, you will have a VAT refundable. Okay, so this is just to assist you when you have to do the VAT calculations. Just how do you actually work out the VAT amounts? So if my amount is inclusive of VAT, or I want the amount inclusive of VAT, I take the amount excluding VAT and I multiply it with 115. So what do I want? I want the VAT inclusive amount over the amount I currently have, which is the VAT exclusive amount. Or you can multiply it with 1,15. The opposite accounts for if they give me an amount that includes VAT, but I want to work out amount excluding VAT. I take the amount inclusive of VAT, I multiply it with 100, so what do I want? The amount excluding VAT, I divide it by 115, the amount that I have is the amount inclusive of VAT, or I divide it by 1,15. If they ask you just to calculate the VAT, so not the VAT inclusive or the VAT exclusive amount, then you take the amount that includes VAT and you multiply it with 15. So the VAT percentage at the top is what I want, divided with the percentage I currently have. If the amount is excluding VAT, I multiply it with 15 over 100, as opposed to the 115. Okay, source documents is also something that students need to know about, and a lot of students do not actually read the source documents. They do sometimes combine this with your journals or with your accounting equation, where they ask you to also indicate what source document would you require for that specific transaction. Now remember, these source documents are very important in order for you to claim the VAT. So you need to know what is the difference between a valid tax invoice and an abridged invoice. Now remember, a valid tax invoice is if my invoice amount is more than 5,000 Rand. Both the buyer as well as the suppliers VAT registration numbers are on there as well as their details. So that is the name of the supplier as well as their address. Whereas with an abridged invoice, only the seller's details will be on the slip. You will not have the buyer's details. So anything between 50 Rand and 5,000 Rand that does not have your buyer's details on it, we can still claim the input VAT in terms of the VAT Act. Okay, so let's quickly look at what type of source documents do we actually find in practice. You get the receipt, okay, so that can also be a cash slip. You get an invoice. Now there you will have to know whether it's the original or duplicate, depending on who receives it. Then you have your check and your counterfoil, your deposit slip, your payment voucher, your debit note, credit note, statement of account, bank statement, loan statement, credit card statement. Those are different types of source documents. Now in your textbook, they explain each of these source documents in more detail. They show you what they look like. Please go through that information and familiarize yourself with it. Okay, so let's take an example of an invoice. So let's quickly look. This is Kitchen Candy's invoice. So here at the top, you will see we've got the supplier's details and VAT registration number. So here is our supplier name, their VAT registration number, their details. So they post their address and their telephone numbers. Then on the right hand side, you have the customer's details and their VAT registration number is here on the side. Then normally we have the word invoice at the top. You've got a date. Then you've got a description of what did they actually acquire. So the quantity, the description of it, the price per unit, and then the amount for the quantity that was purchased. Then you need to show what is the amount excluding VAT. So that is everything up here added together gives you the amount exclusive of VAT. Then we add the VAT, which is the 17,100. We multiply it with 15 over 100, gives us the 2,565 Rand. And then to get to the VAT inclusive amount, which is the final amount, you take the 17,100 plus the 2,565 Rand will give you the 19,665. Okay. So in the question, they will either give you the VAT exclusive amount or the VAT inclusive amount based on this document. Okay. Now you need to remember that depending on which one you have will determine what do you multiply it with and what do you divide it. So you multiply it with what you want, you divide it with what you have. And you need to make sure that you know the difference between what you have and what you want. Okay. So let's say they gave us the VAT inclusive amount of 19,665 Rand. You would multiply it with 15 over 115. So I want to work out the VAT. And I currently got the VAT inclusive amount. And then you will get back to the VAT of 2,565. If they gave you the VAT inclusive amount and they want you to work out the VAT exclusive amount, you will multiply it with 100. So that's the amount I want. The one without VAT, divide over 115 would give me 17,100. Okay, so let's quickly see. What will Kitchen Candy record when this money is now received? So now we're looking at the entry in our accounting records. Okay, so they would debit bank the 19,665 Rand they've received. They would credit the sales amount, but that would be the amount excluding VAT, and they would credit VAT output, which is the VAT component here. So you can see there's one debit and two credits, but the debit amount equals the two credits. If we add them together, will give you 19,665. Okay, what will Smith Traders then record on their side if they've paid it? So now we've paid that invoice. We would debit inventory because we've acquired inventory. We would debit input VAT and we would credit the bank. So you can see how you need to also know which party are you looking at, because the entry will also differ depending on which party we are looking at. Okay, so that was learning unit 3. Do you guys have any questions on that source documents or anything else? Is there any questions on VAT or the VAT calculations from your side? You can type your question in the chat function, or you can just pick up the mic and ask me.